Good morning. This is Chris Robinson, Robinson Ag Marketing with today's pre-opening grain and livestock comments for Monday, November 17th, 2025. Why, oh, why, oh, why? That's the answer, right? The question. What's the answer to the question? GM beans up 12 cents overnight after hitting 11.14 or at 11.30, traded as high as 11.38. That puts us only about less than 15 cents away from the high at 52, which is what we had before the report, which is a 17-month high. It could just be thin overnight trade. It could just people be again speculating that China's going to come. If you look at the open interest data, which everybody has access to, it's not a secret. Um, you had 15,000 new contracts come on board in soybeans, 10,000 in corn. Um, you did see a contraction in wheat, so people were dumping wheat there. But here's a piece of information I found, which is pretty interesting. Since the contract, the trade pact was finished, whatever that was in South Korea. Since that, open interest has jumped 122,000 contracts. Wow, I think that 12 million metric tons is about 90,000 contracts. So people are speculating that gain in open interest is what China did, that they bought on the paper what they eventually will buy in the cash market. But that's speculation, it's not confirmed, but it seems to be the only reason that we have this type of rally in beans, especially after, a lot of people were very angry on Friday, and you may be one of them. So I don't worry too much about the why anymore in this market. The price is what matters. I've seen more people lose more money because they needed to be right with their ideas because their egos get in the way. Um, and this is another reason why we use options instead of trading the board. If you're trading the board, if you got mad on Friday and now you're short beans, and now we just had a 20-cent rally off the bottom. You just lost over $1,000 on a big contract that you sold, especially if you sold out of anger on Friday. So use the options. If you're already a speculator, you're already a trader. The problem is as a farmer or producer. The problem is you're always locked in long. So again, why are we up 12 cents? I don't care why. Where are we going to be at the end of the day? I don't know. Where are we going to be at the end of the month? What am I worried about this week? December dated options expire Friday, right? These corns at 4:30, and they're going to suck the volatility out of that stuff there as we head into Friday. If you know you're storing corn, you need to get yourself hedged out in March, possibly as far as May, depending on how long you think you're going to hold it. But you need to get away from Dece and get into March, in my opinion. In the wheat, up 4.5 cents. Chicago up 5 cents. KC up 4.5. So a sea of green overnight. We'll see if it has any legs left in the day. They did talk about the tariffs, right? They adjusted a bunch of tariffs. Uh, they adjusted the tariffs on coffee. They adjusted the tariffs on Argentinian beef. They adjusted the tariffs on stuff coming out of Brazil, but there is still a big tariff if you dig into it. So they did adjust some of the tariffs. Some of the tariffs are less. We'll see what the market thinks about it today. Remember, on Friday, we had a pretty horrendous whipsaw day in the cattle. I would expect another whipsaw day. You're starting to see less volume and open interest, less liquidity in cattle. And it's because bullish or bearish, if you're putting a position on and you've got 12 cents worth of risk in fats and you've got 8 cents worth of risk in the feeders, it's not much fun when you're wrong. So it tends to make people pull their horns in and trade smaller. So my advice is if you have to day trade cattle, cut your positions. There used to be an expression on the floor: trade small, have a ball. When a market starts losing liquidity, you need to start um, respecting that, or you're just going to take huge amounts of swings, or whatever makes you happy, right? Again, if I'm a producer, I'm looking at the options because the options let you manage your risk for a certain price for a certain period of time if you just buy them and you don't get stopped out of your heads when you need it the most. Now, if you start selling calls and selling puts and doing all that type of stuff, whenever you sell an option, you're exposing yourself to risk. And just be careful if you're doing that. Know what you're doing. A lot of people like to do it because they think it's going to be a free trade, and it turns out to not be a free trade. Uh, that is about it. I'm looking at outside markets, pretty quiet. The Dow's about down 100. The S&P is down about 15. Everybody's concerned about is the Fed actually going to cut again? Um, Heading into the holiday season. I will say this: in my lifetime being in this business, when you start getting closer to December, December can be a very difficult month to trade because less and less people trade. Think about it: if you're in the commodity trading business and you've had a good year, why would you want to blow your fingers off at the end of the year? People start trading smaller and waiting for the new year. Again, we're getting closer to the holidays, I think, and it gets worse after Thanksgiving as far as you start getting these whippy markets, just like we're having right now overnight in the beans and corn. So as I talk to you right now, D's corn is up a penny, jam beans up 12 and 3/4 cent, December wheat up 5. We'll see where we are on the close. Again, this week you got to watch D's options expiration. This is Chris Robinson, Robinson Ag Marketing. If you didn't get my letter, if you want to get my letter, give me a call, 312-638-8868, Robinson Ag Marketing. Take a look at my letter. I do a daily letter, and I also do a weekly big deep dive. I spent about 4 hours on it. I sent that out this weekend to talk about price action and how we can take advantage of it, bullish or bearish. If you're an end user or a producer, you need to get your risk on paper. This is Chris. Have a good day.